And joining me on the podcast, and of course, you can see us in video if you want to. That is, of course, some people don't want to see to middle-aged men talking about stocks and shares. But listen, I'd highly recommend it because Paul makes the effort. He's got a tie on, he's got his hair done, everything. That's top half, of course. Paul, welcome along. And I tell you, I don't know what we're smiling because we sort of have to, but I find this market so frustrating. Really annoyed. Part of me thinks just sell up and have a couple of years away traveling around the world, and I'll come back when the bull market starts. So as soon as I do that, the bull market probably will start. It's so frustrating at the moment, these markets. Are you finding it the same or what?
Oh yeah, I mean, there's a great expression I heard on Bloomberg a few weeks ago. If you're not confused, then you're not paying attention to the market, which is just me. I mean, I'm sort of deep into what's happening in terms of the US, in Europe, with interest rates and the banking crisis, and we'll come on to those a bit later on. But yeah, general level of sort of like where we're heading is really difficult. And I would say to investors, the way I'm sort of thinking about it, actually, I'm less of a conviction call on whether we're going to go into a recession, what the markets are doing than I have before, in terms of, there's a big sort of dispersion of potential sort of like, scenarios. My base case, though, at the moment is essentially we've got structural labor problems in terms of, employment, etc. And so what that means is that more consumers are staying in their jobs, effectively, even though the economy may be having a difficulty, etc., or coming onto it. And therefore, we're going to have more consumer spend, which has been driving Q1, sort of GDP and activity levels. Just go into restaurants and it's absolutely rammed. So we've got that structural labor problem, and that's going to mean that inflation's going to stay higher for longer. And that means that the central banks are going to basically we're going to top out peak interest rates, but are not going to reduce as the market is expecting, particularly out in the States. And therefore, we're going to get a repricing of risk. And we're going to continue to play whack-a-mole. And when I say play whack-a-mole, I mean the US banks and any other things, because what will happen it's less conviction, but my base case is such that with interest rates staying at peak levels and not coming down as the bond yield curve is suggesting, that means we're going to get more problems coming down the pike over this next year as things sort of like, keel over. And that could be a bank, it could be commercial real estate, it could be, other corporates struggling to raise money. But we're not going to see this essentially decrease in bond yields towards the second half from September onwards, as bond investors are hoping. We're going to get a repricing of risk. We're going to play whack-a-mole in the interim before the labour market eventually cracks. And the problem is it's probably the Federal Reserve, the Bank of England and the ECB need higher unemployment, but with the structural headwind or problem in terms of keeping, employers are going to keep employing, staff on their books for longer than perhaps they need to because of the shortage, etc. Inflation is going to stay higher, interest rates are going to stay higher, and we're going to see a lot of these mini explosions is what I see. I mean, what's your view?
I was just looking yesterday, right? This is a second or third day in a row where I'm watching CNBC and some of the regional banks, they're dropping like 50% in a day. And I think this is like, you'd see this on AIM when a small resource company is going to drill some oil and they miss a duster. That's happened. But these are regional banks and they're not tiny, and they drop by 50%. And there's shockwaves. And like I said, there is whack-a-mole going on here. But it needs to be sorted, doesn't it? Because it is creating more worry. And like I say, who's right here? Are the bond market right, or is the Fed right? And I got to say, the Fed can change their mind very quickly. And of course, they say they won't change their mind. But it's going to have a huge effect, of course, holding interest rates up this high for this long with that amount of debt. We've got, part of me says it. I mean, central bank, was it Hugh Pill from last week saying, British people need to learn to be poor, a bit more, and not go for industry. And it's okay for you to say that, Hugh Pill, on 300-400 grand a year, traveling around the US doing podcasts and tours and all that. But, if someone's struggling to buy the food they were buying last year, they need more pay and all that stuff. And central banks were largely to blame of this. They've gone from one extreme to the other extreme, with the quantitative easing, quantitative tightening. And they say, yeah, but even when they started quantitative easing, they were saying, oh, there may be some inflationary pressures coming about because of this. Of course there is. I mean, just map the quantitative easing, the balance sheet of the Fed compared to the stock market, it's in lockstep. And now they do the opposite. So I don't know what's going on. Part of me thinks
the key to me, when it comes to what the central banks are doing, is going to be what core inflation does. Okay, that's core services and core goods. We know the oil price, as we've seen it, as the bellwether of the economy, has come off. The Brent is now about $70 a barrel. And compared to where it was at 120, sort of this time last year, that's a significant reduction. We know natural gas in Europe has come down massively. I think it's about 35, whereas it used to be at about 150 or something at the peak of it. So we know those have come down. But where is core, in services and core goods inflation going to be? And actually, I can see with these structural problems, it's going to be 4% by the end of the year. And on that basis, the central banks aren't going to actually cut interest rates. That's my issue. Where I could be wrong is actually with these raw material costs like energy and natural gas. Could that actually feed through into core services and core goods, such that it brings it down, such that even if we do have structural headwinds in the labour market, will it be sufficient to bring it down, say, to about 3%, which may satisfy some of the central banks to reduce interest rates? That's where I could be wrong. But at the moment, well, we'll find out. We've got the non-farm payrolls this afternoon out in the States. It'll be interesting to see what the monthly wage growth is. I think expectation is 4.2%, and we've got sort of like about 180,000 net job gains, I think, for April as well out in the States. So that's going to be a big sort of like decision point. But the key to me, and this is the view that all investors need to have, is the Federal Reserve, the Bank of England, and the ECB going to cut interest rates this year and early next year? Because if structurally core inflation stays higher, the answer to that is they won't, and they will play whack-a-mole, as they've talked about, with the banks, with other things breaking. They'll use other financial tools to solve it rather than reducing interest rates. And that may actually be a bit of QE, because that's what they did obviously with the trust economics back in September, and with the banking crisis out in the States, which will sort of like get over that potential hump. But top level macro wise, my base case is such that I actually think the labour market being so strong is the Achilles heel for the bulls.
Yeah. But do you know what though? Macro, like I said, we can look at macro. Is so confusing a picture, and it's always been like that. Largely the markets don't play out in tune with macro, and so it gets to a stage where you can really go in depth on the macro, all the macro issues, and it can mess your head up. You'll have option paralysis. You'll think, what is going on? I don't understand what's going on. So when it comes down to, as an investor, I would say don't try and control what you can't control, but you can control what you're invested in and what you're going to invest in. And now, if you want to be really, really cautious, go to cash. Or if you want to be, say, I think there's going to be, this value here to be had amongst a certain selection of stocks. Because at the moment, I'm still holding like 33% cash. And I'm determined to only look for companies now that they are very good value, paying a dividend probably, or it's a no-brainer on the valuation over the next 2-3 years. Even if they underperform, they're still undervalued. So it's almost like they've got to be very good value. Otherwise, it's literally, it's not worth going for. It's not worth taking big risks in this market, but where it's going to go. But all you can do on an individual basis is look at companies at good value, and growth.
I mean, I totally get it, and I agree with you, because you've got to marry that micro with the macro, etc. I would say that taking that sort of macro picture though, it will sort of like be aware or beware going into interest rate heavy or sensitive areas. So into real estate where there's lots of debt, etc., is going to be a struggle. Any companies with a lot of borrowing on their balance sheet, again, is going to be a big problem. And also those industries without pricing power. If I'm right, and we do see a stronger labour market, going forward than the investors are pricing in, then we're going to get a lot of continued input, pricing pressure. In terms of sort of like, you've got to be able to, as a company, has got to be able to pass that on to protect their actual margins. So and we just got to look at it. The consumer definitely, you know, you look around here, as I say, you go out for an evening or something like that, and the restaurants are as busy or busier than they were running up to Christmas. I mean, they're absolutely rammed. And likewise, you look at the sort of like the holiday bookings into the airlines and overseas travel and this sort of stuff. Again, it's really full booked, and things like casinos. And now you've even got, and I know it's a bit sort of a technical issue, but you've even got a recovery a bit in the housing prices. You know, you've got US house prices going up, and you saw Rightmove last week, saying they've actually seen, month on month increase, a small increase, but, not a noticeable one. And that's, it's a year on year. So, you look at it and you say, well, the consumer is still a consumer who is employed and is getting real wage increases or strong wage increases, is spending. And that's, as I say, that is actually a bit of a problem for the central banks, or for the market, certainly for the bond market. If it's going to have, if you're going to assume we're going to get interest rate cuts later in the year, you've got to assume that the labour market cracks, in my view, unless I'm totally wrong, and essentially the reductions in energy costs are sufficient to bring down permanently and sustainably the core services and goods inflation, which frankly I don't believe will happen.
Yeah. No, I know and you are, like I said, this is your full-time gig. You're looking at the macro all the time. Now let's look at an average investor who's got a job doing something else.
Yeah.
They have to get their head around this. So, like I said, all you can do pretty much is, again, first and foremost, in debt, avoid companies with debt problems, or big money debt, because you don't need to. There's plenty of companies out there with no debt whatsoever. And in fact, bringing that into context, you're talking about house builders, and you are seeing some positive shoots coming out. And a lot of house builders have said this recently. And in fact, I don't know if you saw a report by Zoopla saying first-time buyers now are literally being pushed into the buying market. The renters they were, because they can't afford to rent. And I think it was a report saying apparently if you get a mortgage in the capital, if you can get the deposit, 30% cheaper than actually renting. So if they've got banker mum and dad, they're saying, I'm just throwing away money on rent and it's costing me a lot of money. So they're now getting onto the housing market. And there's other signs there. There's like Sunak now rumoring to be going to buy, or help to buy scheme again, reviving that. Because, of course, with trouncing in the local elections, I think they're under all kinds of pressure to help people get on the housing ladder, do anything they can for the economy. So it's going to, I own some like MJ Gleeson. They're down over 50% from where they were, a while back. And largely that was, the worry of the trust economics, where there's no mortgages available. And now there are mortgages available. And was it news today? Yes, that's right. Was it right move? I think you were saying there.
Yeah.
They are now
month-on-month increase.
Course, month-on-month increase. So it's stabilized a bit. It's not going to grow, of course, but stabilized. And I just think if you're looking out, I mean, very simplistically, if you're looking out 2-3 years and you've got a house bill that's down 60%, it's a good business, no debt whatsoever. And you think, okay, do you think the housing market's going to improve in the next 2 years? And a simple question, I think, yes, it is. I mean, the interest rate is probably going to come down. It's going to be a lot more buoyant. And so these house builders, I'm not saying we'll get back to their former glory of 2021 within 2 years, but they'll definitely be higher than they are now, because they're like 50-60% lower they were. So,
It's a difficult one, because I actually see there's a bifurcation in terms of what's happening in the banks, etc. Because what you see is that you put yourself in the position of a bank and you're lending money, okay? Mm-hmm. Now you're a bit concerned in terms of what's happening in sort of corporates and, with their debt, and you're rolling over, etc. And we know from what's happening in the States with the senior owned loan officers reports and what's happening in the UK when people try and raise money, for corporates at the moment, it is really tight and really tough to actually raise any money, whether it's debt or equity. We've known that for months, okay?
Yeah.
However, if you're an employee, you're basically a consumer who's got a job and it's increasing salary, etc. It's actually a piece of cake to get a credit card or to buy a house. I mean, there's plentiful mortgages and the availability. It's pretty competitive. We've seen mortgage rates coming down. So when you look at through that lens, we've got a two-speed economy in terms of getting credit into the actual economy. Consumers with jobs, pretty easy. And that means in terms of your housing market is such that actually prices are probably going to be pretty stable, no doubt about it, as long as you don't see cracks in the employment market. And I actually, as I say, I think we're going to see a strong labour market for quite some time, and therefore prices of properties are going to be fairly firm. But that doesn't mean interest rates are coming down. So I actually think in terms of the house builders, what they produce, what they actually build, they'll be able to sell. Where you've got house builders like Gleeson, Taylor Wimpey, Persimmon, without any net debt, actually strong balance sheets, they're going to be fine. The only house builders you're going to struggle are the ones which actually need to raise money. Any company wanting to need to raise money is gonna have a problem. But if you're a house builder, as I say, or any other corporate with net cash on the balance sheet, you're probably going to do pretty well, because you're going to get actually higher interest coming through on the below the line, amount to help your earnings, because you've got cash. But if you're going to be trying to raise money, you're going to be taken out to cleaner. So when it comes to sort of stock picking, I actually think it's going to be, if your thesis is you're relying on interest rates to come down in the short term, I think you're going to be wrong. But if like you've selected a fundamentally undervalued business like Gleeson with cash on the balance sheet, and it can sell its properties into a pretty strong consumer, then I think you're probably fine. I mean, I can't see any issue with that at all. I mean, what's your view?
Yeah, no, absolutely. I mean, when you say short term, I think again, who's right or wrong on the interest rates, I don't know. But I mean, I'm talking, within the next 2 years, I think, of course, I don't think it'll be this anywhere near this high in next 2 years. And anyway, like I said, already at higher interest rates, people are buying houses. We are a nation of house buyers, so it's fine. And with a dividend yield of like 4% on, and that's just on Gleeson. There are bigger dividend yields out there, but I mean, I think prefer the capital upside with Gleeson. But I think dividend yield sitting there, some 4% on Gleeson, I'm happy to take that. So
what do you think? What do you think? Just switching gears, what do you think about the oil price coming down so rapidly? Because the thesis at the start of the year was that the China reopening was going to add an extra 1 million to 1.5 million barrels a day into sort of like into demand, and that was going to push the price up. Plus, you've got obviously the US refilling its strategic reserves, etc. That has gone totally pear-shaped. It's actually gone the other way.
Well, do you know what? It's a chart out there. I'm trying to find it, but it literally says oil price and recessions. That's it. And it's an amazing sort of. And if you look at this, there's a chart here. Every time the oil price pretty much goes above $100, there's a recession that happens very soon. I mean, it's come from 1975, it happened, 1990, in fact, just 2000, 2010, and it's happening again. And the chances are happening. It's almost like it is self-correcting, isn't it? Whenever oil prices goes up, everything gets more expensive, pretty much, and then people have to pull back, and that's what happens. It is. So you've got to say there may be. The thing is, there's so much talk of recession now. There's so much talk of it. You think, will there be a recession? Because not everyone is right, and so even if there is a recession, how much is in people's heads already? This is going to be a recession anyway. We know that. So it's almost like what's the market pricing in? What are we expecting? Generally, you get big hits in the market when something happens that you don't expect. And if everyone's expecting a recession, then maybe just trading in a range like this for a while. Like I said, we've had lots of data coming out. You get the Federal Reserve raising interest rates. You get a volatile market for a couple of sessions, but it hasn't retested the October lows. And so that says a lot. And it's a while back. How many months back is that now? We're May. And so we may have a bit of a rally and then a rollover, but I don't know if we're going to have a big sell-off, scary sell-off. There are certain scary things out there, like the money supply, for example. And I've seen that, quoted a lot, saying last time money supply has contracted like this, there's been depressions and all that. I think, is that the case? I mean, are we more flexible now as a system than we were back then? A lot has changed since then.
The big thing about money supply is that actually, in totality, it's still 20% higher than it was pre-pandemic. So, okay, it's coming down, but it's coming down from really extreme levels. And it all depends on sort of like where it sort of like, peaks out at or bottoms out at. But it's still a long way to go before we've got, problems with liquidity. There's masses of, sort of money still flying around. There's this M2 money supply, no doubt about it. I would say in terms of my, recession call, I'm more concerned about 2024. I don't think we're going to get a recession. We may get it the back end of 2023, but actually, because it's, you get that technical sort of recession, etc. Because But I do think it's going to take longer for the labour market to start really cracking. And let's just assume that we don't get a hard recession in H2 of this year, but I think that will roll forward into 2024. And my view on the market is that it typically views what the economics is doing sort of 6 to 9 months in advance. And so if you backfill that, or sort of like bring it in, then I think you're looking at sort of like, I'm worried about Q3 of this year, because if you take that 6 month, 9 month sort of like forecast, and we get tougher times in 2024, then earnings for next year are going down, and we basically going to get a correction. So I think you're fairly safe for this quarter, in my view, because of the strength of that labour market. But again, I come back to sort of what the central banks are doing. I think they're going to play whack-a-mole for longer than people expect. Interest rates are going to stay higher, and the labour market is going to carry on. The consumer's just going to be driving that economy forward. So if you're in experiences, holidays, casinos, I think you're going to do well. There's no doubt about it. It's really when is that labour market going to crack? And with AI coming in, with technology and stuff like that, I think it's going to be next year, not this year, because there's just too many jobs around, and people are getting good. They're spending all the money, aren't they? They're enjoying themselves.
Yeah. Well, no, it does make you think about, why is that yield curve so inverted compared to previous times? Is this something that we don't know? And just then, when you mentioned AI, I think maybe that's it. Maybe the robots take over. Because it's becoming increasingly worrying. In fact, did you see yesterday, they were like, all the big guys were summoned to the White House and told, all the guys from Google, and say, you have a moral obligation to protect people from AI. So it's getting to that stage, and even Elon Musk is sort of warning that AI needs to be curbed, And we've seen these sci-fi films before where the robot takes over, and you're thinking, because it is amazing. Do you know what I tapped into ChatGPT? So, good investment strategies, and literally it was about 5 points of what you should do. So there's no investment strategy that fits all, but things like diversify, and very good advice on 5 points. That's quite good. But I mean, it is a bit worrying how intelligent these things become, in artificial intelligence. And will it take? I don't know. What is the big? That's the inversion of that yield curve. It's like a historic, movement, and I think, well, what is that pricing in? There's something there we're not seeing, and I don't know what it is.
Well, in my view, if the yield curve is correct, okay, then we've got a problem. Actually, what we're saying is that we're going to get a tough, hard recession. We're not. What we're saying is the central banks and the government aren't going to be able to play whack-a-mole for very much longer. Something material is going to break. And I think probably the bond investors are saying, actually, it's going to be commercial real estate, which is going to go, and or you're going to get some of these zombie firms, blowing up, etc., in the second half or quite quickly and rolling over. The bond market is basically saying the labour market, unemployment is going up quick, and I personally don't think it's going to happen, but I could well be wrong, and if I am, then I'm wrong about my call about the recession being pushed out to later this year. We're going to get it tougher sooner. But I just cannot see the central banks reducing interest rates unless essentially core inflation comes down. And core inflation, 70% of it is labour. So you're looking at the labour market. But I could be wrong in terms of, oil and gas and other goods come down sufficiently such that the core inflation rates is sustainable at about 3%. If they get that view, then you do potentially get that soft landing. But I think given all of that, that's a big ask. That is, I'm more worried about 2024 than I am this year, because I still think consumers are going to roll. And with regards to AI, it's encouraging people in corporates to put it in all as much as they can, and you're starting to see it in terms of replacing headcounts and stuff like that. But the big issue is going to be in the next 5 years, not the next 5 months.
Yeah. Well, maybe it's a combination of both, where you get people laying people off and saying, we can do this with AI anyway. So productivity improvements.
Yeah, it could really sort of jumpstart it. Yeah.
Cool. Okay, so individual stocks wise, what are you looking at?
Yeah, I mean, I've just on my own portfolio. I mean, I haven't done that much news as much as anything. I had sort of big pharma. I mean, as a top level priority wise, or sort of like, you know, where I'm positioning my portfolio hasn't really changed. It's still big defensive pricing power, strong balance sheet, secular growth trends, which lead me to tech and to, you know, pharma. And in the pharma area, we had two big companies reporting, Roche and Pfizer, both about sort of like, you know, $225 billion market caps. They both beat their expectations. The shares went down. It just shows you. And I think that's partly because there's a bit of repositioning. A lot of investors were overweight. They were overweight energy and the banks and healthcare coming into this year. And so they've basically rolled that down, that weighting, and pushed it into sort of technology, which is obviously roared. But I was pretty impressed by both of them. As I say, the earnings were good. Okay, sales went down, but it's a transitionary year, 2023, for both of them, because they had big boosts in prior years because of COVID in their drug pipeline. But they're replenishing that. And if you're looking for, say, Roche, etc., you strip out COVID, then their core drug business actually went up like 4 or 5%. So that was pretty good. Strong margins. And they're trading at about 14 times. So I'm very happy to hold that one. The only problem with Roche, which is a bit of a pain in the proverbial, because I'm a UK investor, and I've mentioned to you before, you get this withholding tax issue in terms of on dividends. And the law says it should be 15% if you can claim back the extra 20% you charge at the sort of like, you know, when the dividend is actually paid, you can claim back that extra 20%. Now, I've been trying to do that through my broker, and they've just been like shutting the door on me all the time in terms of, we're not going to give you the information to be able to claim back that 20%. So that's a bit annoying. I need to fight that and get that one sorted. But I would say, if anybody wants to follow me into Roche, you just got to be you're going to have to pay withholding tax, and 15% is fine. But when it's 35%, it just makes it a bit sort of a stinger when it's a good 3.5% dividend yield. With Pfizer, they do a similar sort of like, you know, dividend 3.5%, but because I hold it in my SIP, then you don't get any of the withholding tax at all. But again, Pfizer's got a good pipeline. It's replenishing it. It's got this acquisition that it potentially will complete towards the back end of next year, back end of this year or early next year, which is Seagen for about 42 billion. But again, their underlying business is doing well. They've got lots of new products coming in. They've got a new vaccine coming out for RSV. And in fact, I think it's, you know, sort of like right in the sort of like, you know, the similar sort of thing as Glaxo. But they've got a big one for migraines and stuff like that. So, I mean, they're big pharma. You're never going to make £1 million out of it. But if I can do 10% per annum with a nice dividend, I'm happy. I'm happy as Larry, and I'll just hold them for solidity. What about your portfolio? Have you had anything coming through?
It's right. So I've since I took hammering on, I did really well on the micro cap stocks, you know, up into the bull market, and I could never done that in big cap stocks where I've done. But then you realise, then you get the liquidity drawdown and all that stuff, and you can't sell. You've got too big of positions in small cap stocks or micro caps, and you can't get out of. And so literally, I'm correcting this. And in fact, I meant to do it before I got greedy on micro caps, but I did have a plan to sort of diversify a bit more. But I've sort of done that now, and I've got, you know, like if it's 5 different sections of companies I look at, I try and diversify not only through sector but through size as well and liquidity. And so I've got the big caps there. In fact, I've made the plunge on Future PLC. I know they're taking a hammering. I know the advertising market's down, but they're down from like 40 quid to 10 quid. And they're at a PE of 7. They've never been that low ever. They normally were doing P's of 30, 35, 40, and their growth is phenomenal. And they've got so many sort of, they've got the strategy where they've got so many websites that plug into each other, and the synergies are so strong that even the top line that may not be good, their margins are going to hold strong, and they said they're in line for expectations. But I've got Money Supermarket as well. I've got Pets at Home, but there's sort of wealth sort of, sort of creators. They hold your wealth, but if you want to make sort of, double or treble your money, you've got to take on a bit more risk. And like I said, and I do have that throughout the micro caps, so I can see those kind of things doubling, tripling. In fact, I did a sort of video last weekend on Destiny Pharma. And I just find it phenomenal where they were and where they are now compared to where, what they've done since. And I said, if you go back even 18 months, they were like 180 a share, and they were less developed, they had less cash. They've got 2 assets going to phase 3. And the clinical data from phase 2 is very compelling. And like I said, apparently the XF73, which the second asset they have, a deal has not been done on that, but that's twice as big as the first asset, pretty much in peak sales. They wholly own it. and they say it's market research say this could be now the potential to replace the current standard of treatment. This is for Staphylococcal aureus infections. And they're active partnering discussions are happening right now. And actually, they are like a 30 million market cap, 10 million in cash. They've got a runway till H2 2024. Now, if they do a deal on XF73, they seem very confident of doing this in this year. Then that runway will be extended. But I don't know any company like this, except on three. These are not. They haven't got data from like animals or from in vivo, in vitro. These are they've gone through phase 2. These are human data. They've got very strong data going to phase 3. They've got a partner on their first asset, and yet 3 brokers have gone for an average of £2.80 target price based on the commercialization of the first asset, just the first asset. Second asset could be bigger than that, but twice as big. So they're going, okay, it's a silly upside anyway. They are like 33 pence. And the broker target is 280. It's a silly upside on that. Now that could more than double, because the second asset is as big and they're going to land a deal. And there's also bigger potential within both these assets. And so it just boggles your mind. As I said, if you go back like even 18 months, they were like closer to £2 a share. So they were closer to that target then. And that's the bear market. There are these opportunities. They will be volatile. But what you've got to understand is that, if you're going to invest in risky propositions, and there's been quite a few popping this week in the microcap space, doing like 200%, 100%. But some of those don't have cash, and you think, well, that's not going to be sustainable. So if you're going to invest in these, high risk and maybe wealth creators that could transform your portfolio, don't go overboard in them, but also make sure they have lots of cash, because it's going to be hard, like we said before, to raise money in this environment for a long time. So as long as they got 12 months or more cash, it should be fine. And then that way the story can play out without the burden of worrying about, raising finances. But so I like that. In fact, just now, have a word with your mate Jamie from Singer's Capital Markets, because I just see XPF Factory, which is like literally they did 22 million they've done this year, in 2022 in revenue, which is from a standing start pretty much of like 7 million a year before. Forecast to about 14 million this year now, and have an EBITDA 6 million, and they're now valued 24 million market cap. They've just announced that they've taken on Singer as their change of advisor, nominal advisor and broker. The share price is down 10%. What's going on? If people just worry about fundraising or that, they don't need cash. It's just just in this market, any bit of worries or wobbles shakes the share price. So they don't need cash. They're doing very well. They're profitable this year. It's fine.
And I'm with you, and they're right in that sort of consumer experience space. And if I'm right, then actually I think consumer stocks, certainly for this year, for the foreseeable future, are going to carry on doing well. And I think that, it came out with that Oxford Street, or the other flagship store they've got on that, in the middle of London, has done really well for them as well, hasn't it? I mean, it just shows you how the demand for that whole product.
No. I mean, if you go to you can't just walk in off the street on these boom battle bars now. You've got to book in advance, way in advance. So there's always people, and I it's like now every sort of quarter or something, a couple of friends of mine come down and stay with me from within the weekend podcast. We've known each other for years. And we went to Boom Battle Bar last time. They said, I said, what do you want to do this time? They said, oh, Boom Battle Bar again. And literally, you've got to book within a month. Is that they're all booked out. And so I don't know what the worry is. It's just in this market, people are just worried, aren't they?
Yeah.
And Oh, by the way, Breach had another rally yesterday. I don't know.
No, I don't know. I mean, I saw it as well. I mean, again,
isn't it?
Yeah, you're going to get it. It might have been tipped, I'm not sure, by somebody or whatever. But a lot of these sort of like, rise. I mean, they've come down a long way, so they're really sort of like ultra undervalued. But we'll have to find out on that one.
Go on.
We had another one, which was last week, which was Avacta, which came out with its prelims. Everything was on track in terms of the development pipeline, particularly for their precision platform in terms of their AVO 6000 prodoxorubicin drug. And they're finishing off the phase 1A at the moment, finding that maximum tolerated dose to move into the phase 1B, which is to the escalation phase, and to start sort of like getting that optimal dosage level for patients, etc. So that's doing fabulous, etc. They've got a new candidate as well out in the States, which is basically they've going back to the prodoxorubicin. They've started dosing people in the States with the AVA 6000, which is great. And then they've got the second candidate as well, the the next pro drug on the platform, which is hopefully going to go into clinical trials next year in 2024. And the diagnostics business, which they bought last year, is bedded down well, be profitable, generating good revenues, etc. So, and they've got plenty of cash. They got, as of December, they had over £40 million worth of cash. So they've got plenty of funds to be able to take them through, for the foreseeable future. So, yeah, I mean, it's a bit like Destiny Pharma. If they can get, if that precision platform does actually work, then the market for that product products is absolutely huge. I mean, it's chemotherapy, targeted chemotherapy, which will just be transformational. I mean, we're talking billions and billions of dollars in terms of each of those, end use cases. So huge unmet clinical need, and they're making very, very good progress. Yeah, and the next, the CEO Alistair Smith mentioned, said the next big valuation or the next big, catalyst for the value catalyst is going to be when they start doing the efficacy data, which comes out in the phase 1B. So yeah, towards the back end of this year, but yeah, all going well, really.
Yeah. I don't know if you saw that IAG came out with results the first quarter, and they said the leisure sector of the market. I own one stock in this area, is on the beach.
Yeah.
And I know you're talking to, was it Richard? I think about, and he was talking about on the beach recently, I think. And yeah, it's funny because that's quite a volatile share price. They've got literally 65 million in cash. They raised money at a good time, actually. They have no debt whatsoever. And I quite like these portal sites, which are like, they don't own, low capital model where they don't own any stock or anything like that. They just have a website and there's a broker. And they've got very good margins, but literally the share price is so frustrating. It starts to rally, you get somewhere, and then it comes back and you think, what is going on? So they've got their news out, obviously results coming out end of this month. But if you look at who's released so far, man, look at just listening to a podcast that Trivago sort of came up with good results, and British Airways. It seems to be, a lot of people want to go on holidays, because they've been cooped up for like last 2 years. So hopefully it'll play through. But it's funny. I got to the stage where I thought, it's just going down, it's doing my head in. I may just sell and take the loss. But I thought, no, hang on, have a bit of patience, wait for the results, because the results shouldn't be that bad. They're only about forecast a PE of 10. They're growing very quickly. So it's just, I'm so frustrated in this market. I may make mistakes by saying I'm sick of just companies rolling over for no reason. But you just sometimes got to just hold on. If you know the results are going to be okay, then just hold on. And that's what I'm trying to convince myself to do with certain stocks, because it's frustrating. Fundamentally more.
I think you raise a really, really good point for all sort of small and micro cap investors. Do not be surprised if the shares go down 20-25%. It's happened to all of mine. I mean, I look at equals, I've held that for 3 years, and that regularly goes down by 20. I mean, when we look back before they put the prelims out, it was back down to below, I think it was 65p in the middle of March. And now it's 90 and it's been rock solid. So, I mean, that was a good third it lost, and that's a cracking company. Another one which I own, which just came out a trading update last week, is Activeops, which does sort of like automation software for complex back office processes for banks and insurers, etc. And that went down to just above 70, and then has bounced back to 90 now. So, I mean, Activeops is a good solid business. I value it at around about sort of 125p per share. The brokers at about Investec are about 150, but they're being driven by good top line growth in terms of, I think they did 11% last year, but they had more momentum in the second half. It was a much higher level of organic growth in H2 than it was in H1. So there's lots of sort of like, and they've high gross margins, pricing power. So it drops down through to the bottom line. They'll be profitable and cash generative this coming year, and they've got plenty of cash. So, I'm delighted to hold that. But the big picture is, do not be surprised if your shares go up and down. I mean, another one I own, which is quite a big one, which is First, derivatives, the old FD Technologies business. And again, that regularly goes up by 20-30% or down by that sort of level. And you've just got to accept that's the level of volatility at the moment, because just the way the market is, it can be hugely frustrating.
Yeah. Well, do you know what? I saw your interview. Was it with a lady from Aberdeen, I think?
Abby Glennie,
Abby from Aberdeen, yeah.
Yeah.
she was talking about a company I was looking at, because I was looking at getting some more dividend payers, and I was looking at FDM,
Yes.
the company there, and I do like them. I found them by a screener first of all. And I did some deeper research, and I liked them. I liked their growth, and their dividend was nice. And she talked about that, and I nearly hit the button to buy. And then the Fed came out with an announcement. They dropped like about 4%. Now I thought, I didn't, So I'm going to wait and see what their results are like, because they are in the tech sort of employment space. And I thought it's taken a bit of a knock. They must take some kind of hit from that, even though I understand, some companies may contract out to them rather than have their own staff. But it's worth just waiting. In fact, it's a lesson learned in this market. You can afford to wait pretty much. Because I said recently on a webinar that you find most investors tend to be over optimistic about results coming out on the companies they own. And as far as I can remember, I've never known results come out in a company I own that's come out, and even if they've gone well, I've never known the share price go berserk anyway. Normally it rallies towards those results and then comes off a bit. So never go nuts just before the results and buy into a company. You're always better waiting. And I did this with Alpha Wave Semi, they're called. They're a mid-cap company. They do semiconductors and all this, but their growth is phenomenal. It's literally, if you look at the top line growth, it's almost doubling every year, pretty much the last few years. And I thought, I knew that obviously the results were on the 28th, and I thought, should I get in before the results? And I nearly did, and I thought, no, I'll wait. So first and foremost, they didn't meet expectations, but they did quite well. The growth was quite good. Then, secondly, they had some discrepancies on the figures, so they had to re-release some figures. And then all of a sudden, they hadn't been audited on time. The auditors said we can't audit you on time, so suspended. So they dropped about 16%, and now they're suspended. I'm glad I didn't get in before the results. So it's always worth waiting a little bit, having a bit of patience, So and so I'm going to try and get better at that, but having more patience, because I find I've only ever lost some money when I've rushed into something and been overly enthusiastic. So, getting in too quickly and overexposing, those two things there, if I can correct that better, more patience, a bit more conservative on initial investments, So
all I would say, good luck with that, because I've had plenty of patience getting into stocks and plenty of research, and I've lost many, masses of money on lots of stocks. So even if you do a lot of due diligence and you're patient, just don't be surprised if you still lose a lot of money, because
I suppose
that's the nature of the beast.
And I suppose when you come down to it, what is life about? It's not about. It is about traveling. It's about learning, and part of that is that I said I would want to keep investing until I'm dead, as long as my mind holds up. It's one of those things, like I said, it's a game pretty much.
Yeah.
The market opens up and I get bored on bank holidays, which is annoying for this month, because this is the way it goes. 7 a.m. you get the news coming out. It's almost like starters orders, and then it's 8 o'clock and they're off, and that happens every day of the week. I'm trying to figure out how to get better at this game. That's the thing, It's not the actual conquering it or sussing it. It's the keeping your mind active, trying to find ways to get better. That is the game. It's not the actual, it's not saying banking $1 million and switching off. That's not the point. I remember years back, people saying to me, when I was kids, if I made £1 million, I'd retire. I say, if you're the kind of person who can make £1 million in business, you won't retire. That's not the goal. What drives you to get there continues to drive you. So it's like the enjoyment of investing and figuring out better ways of doing it. That's the game, isn't it, really? And so this frustration, really, I suppose, with me is like, and it makes you evolve a little bit. Like I said, right now, I'm finding better quality companies, valued better, because it is frustrating at the moment. In fact, just on the microcaps, I don't know if you saw recently, there's to me, that signifies the bottom of the market is sort of here. Microcaps are starting to rally now. You're seeing almost 100. I've seen some myriad of advertising, myriad, and Ondo as well, and a couple of these hope high potential stocks rallying like crazy because they've been so oversold. And I'm talking about myriad, like 7 million in cash. They were 3 million market cap. Yes, they're loss making, but when you get those sort of levels, you think that's ridiculous, because you can just buy the company and take the cash. So when you get those levels, you'll see these massive movements, and so. In fact, me and John Human yesterday were looking at companies that are profitable but below net asset value. So obviously they're adding to their asset base, so that's growing. So, but I'm quite encouraged by there are certain big rallies happening, because these companies are so oversold, which says to me, we are around about the market bottom, but it's just we're going to have a bumpy. The bottoms are always a bit bumpy, aren't they?
Yeah, I mean, even though I've got sort of like a fairly. it's a confused outlook, but you know, I'm overall bearish in terms of what's going to happen on the markets in totality in the second half. Although if there's good opportunities, I'm buying. There's no doubt about it. I've got 40% cash. I'm going to start putting, you know, putting money to work. It's just there's a matter of getting the right time and the right sector. And as I say, I'm still staying with, if I can, in sort of like good pricing power businesses with strong balance sheets, with good secular growth trends, and you know, just biding your time and doing that. But you know, the key is, I think the key is sort of like, if something moves up high and you know, is it sustainable? And I'm there for sort of like a 3 to 5 year outlook. I'm less interested in sort of like pops, you know, sort of like 1 or 2 weeks, because I mean, I can't get into these stocks anyway, and I can't get out because I put a significant number in, you know.
Well, I found that. That's why I adjusted my spreadsheets now, like I said, to bring in average daily volumes and actually put 10% of that. So if you're if you're going to sell 10% of the average daily volume in a day, or try and buy, it's going to affect the share price pretty much. So you've got to be that margin of error. And it has changed my outlook, and that's why I've obviously got up the market cap. It's okay in a rising market. There's a lot more liquidity, and in fact, stocks that do rise, their average daily volume goes up. But you've still got to account for that. If you are going to hold a big chunk in a micro cap stock, how are you going to get out if it starts falling? Because then it compounds the problem. Everyone's trying to sell, and it gets really restrictive. Cool. Anything else there?
No, good. Well, as I say, we've got the bank holiday this weekend, which is good. I'll be tuning into probably CNBC and Bloomberg on Monday, because the US markets and the European will be open. There'll be plenty happening. There's no doubt about it.
Yeah, that's a good thing. If it comes down to watching the coronation or CNBC, I think it's CNBC for me every time. Marvelous stuff. Speak soon. Cheers, Paul.
Cheers.